Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
With that, let's invite our market master for the morning. Nilesh Shah, Managing Director and CEO of Envision Capital, joins us now. Good morning, Nilesh. Always a pleasure when we have you with us, and we do wish you drop in oftener. Let me start with ICICI, actually. It's the leader of the pack today, 3% higher. Do you think corporate banks, clearly the day has come and you would go with them?
I still think probably one needs to wait for a few more quarters. I'm not entirely sure if all the bad news is entirely out there. We've seen the corporate banks continuously say for almost now 3 years, and every quarter they come up and saying that the worst is over, and by and large everything seems to have factored in. But every quarter you kind of end up seeing that the slippages continue.
At one point the wolf actually came.
Yeah, so now you really don't know when that happens. But my sense is that overall I still think that there could be pain for maybe another 2 or 3 quarters or so. So I think if we're willing to look beyond FY19 and some of these banks are able to resolve some of the leadership issues which they have been facing, I think these are the 2 factors one needs to keep in mind. So I think if you have probably another 2 to 3 year horizon from here, maybe on a relative basis they look attractive because of the valuations and the fact that these stocks haven't gone anywhere for now several years. So it's probably still a contra bet. I would probably think that.
Nilesh, good morning. You think the problem that the market had about the narrow nature is over, or you think it's going to be that kind of a year, the last 2 week rally notwithstanding?
I think that continues to be a concern, and I think that's something which will still continue for a few more quarters. I still think that rest of this calendar year we'll continue to see the market displaying pretty much a similar behavior that it has been doing for most part of this calendar year, and that's because I still think that the retail participation has kind of come down significantly. Global investors continue to be cautious on emerging markets, including India. And I think that some of the global headwinds will kind of resurface sometime towards the end of this year. So I think keeping that in mind, you're still going to see this market behaving in a pretty narrow way, pretty much like what it has been for the last 4 to 6 months.
What about earnings season? What have you made of it? Any upgrades, downgrades that you're expecting going ahead in any sectors?
I think overall it's been a mixed bag, though there have been some real strong pockets like technology, consumer staples, private credit players. I think this has really been a basket which has really displayed some very, very strong momentum in earnings. And it looks like that this momentum will continue for them still for a few more quarters. Versus that, some of the sectors linked to the core economy have really not done well. So if you really look at cement, the numbers still, there seems to be still a lot of margin pressure. The capital goods space, I still think that's again witnessing a lot of challenges. So I think sectors to do with the core economy face challenges. And then of course the entire consumer appliances space, they have been having weather-related problems. So they've had some really weak quarters. So I still think it's a mixed bag, but on the whole, on an aggregate basis, they are a lot better than what one really thought they would end up reporting.
Presaged my question, actually. You were the big discoverer of Symphony, and a lot of people made money emulating your arguments. But now, do you think that play is over? Is it that the market's now moved on to air conditioners? I mean, is there a consumer upgrading? Or is this just, as you say, weather-related and you will keep the faith?
Yeah, I mean, just a disclaimer and a caveat that we continue to own Symphony. But I still think it is weather-related challenges, because it's not that in the last 2 or 3 years that every household now has an air cooler. Yeah. There are some advantages which are there for an air cooler, and I still think those advantages remain. And specific to the company itself, that earlier on it was kind of looking at just the domestic market. It has now chosen to basically kind of expand itself and have a larger international footprint, which could be an important growth driver for it. So it's just been that they've had some 2 back-to-back challenges in terms of the weather. But I still think that the long-term opportunity is not yet entirely lost for the company.
Okay, Nilesh, I remember when IT and pharma were going through that rough patch. You had said that perhaps that was a great buying opportunity, especially in IT it was. Now we've seen such a big run, TCS hitting all-time high market cap, Infosys at all-time high. Your thoughts on IT and in pharma? You reckon that the top-down move is done, or is there still enough room in pharma as well?
So first on IT, I still think that they'll continue to witness some strong growth momentum. Clearly, the U.S. economy still continues to be very, very strong. Spending on technology continues unabated, and clearly the currency is in favor of the technology companies. So I think a combination of these three really put it in a pretty strong position, puts the sector in a pretty strong position. But one needs to be really careful that if the currency stops, the dollar stops appreciating and say rupee gains back its strength, which could potentially happen maybe a couple of quarters later, one really needs to see at that point of time whether the technology sector is able to continue to post such strong margins. I think that continues to be a strong watch area, I would say. Coming to pharma, I think this space is now becoming interesting. And that's purely because I probably think pharma was where technology was 2 years back. Difficult to time it. You're not able to kind of time it saying this is the bottom and things are going to look positive. You probably run the risk of getting into the sector a bit early on. But the way I see that if we were to have this discussion a year later, and we'd say that the base is now so low, there were so many risks. So if you really look at exactly 2 years back, what were the risks to do with technology? Saying is H-1B visas are going to become difficult to get. Technology companies will have to put more people in US, which is going to basically increase costs, reduce margins, and everything, all of that. There were only concerns that we could see. But you could see that technology companies do continuously generate cash flows, do buybacks, and all of that, which improved ROE, and therefore the sector ended up being a huge outperformer. It's quite possible pharma could go through that. It's tough to say right now when this will happen. But what I can see right now is that there is really a consensus that the sector continues to face a lot of challenges. Pricing pressures are there, regulatory challenges are there. But in the process, the base is coming down. And I think that probably could augurs well for the sector, maybe with a slightly more longer-term horizon.
Okay, well, yeah, there are a lot of landmines in this sector as well, right? The likes of Lupin, etc., have not done too well. But I wanted your thoughts on one space where there have been growth guidance upgrades coming in, the commercial vehicle space and the tractor space. So we've seen the likes of M&M, Escorts, Ashok Leyland all raise the growth forecast for the next year. Does that make you bullish?
I think I'd probably be more bullish on the CV segment versus the tractor segment. The tractor segment really has, in a sense, posted great numbers after a couple of years of, bad numbers or not so great numbers. And we have to keep in mind that this is a cyclical business. One cannot, in a way, get carried away with numbers for, say, 1 year and extrapolate saying this is the long-term trend. Finally, I think the tractor business is going to grow in single digits over a period of, say, 3 to 5 years. And one needs to be cognizant of that and ensure that you really do not overpay. But I think the CV space looks a lot more attractive because clearly I think over the medium to long term, that's been a sector which I think in the last 3 to 5 years has not done as well. And it's quite possible that they're getting into some period of double-digit growth. And therefore, that's probably a sector we'd be more positive on versus tractors at this stage.
Okay. Broadly in the finance space, where would you make fresh purchases? I mean, banks, non-banks, insurance, the entire gamut, wealth managers.
I think the insurance space looks the most attractive right now at this stage. And that's purely because of, the reality is that India is highly underinsured. We are underprotected, so to say. And clearly, if I were to kind of look at the next 5 to 10 years, I mean, this as a sector could be probably 5 to 10 times of what it is today. Okay. The whole call is that you make the bet on the right play out there because there is now a choice. You can bet across 3 to 4 names. So the whole idea is to bet on the right name at the right price. If you get that right, I think the payoffs could be significantly higher.
Okay. What's the biggest risk for this market now from here on? Is it politics? Is it crude? Is it just the complacency?
Earnings.
I don't think it's going to be crude. I think crude somewhere seems to have played out. I know this is a bit of a kind of a contrarian call, but I think it was pretty much like at $30, everybody thought crude is going to go to 0 or 10 or whatever it is. I think right now the consensus is that crude is going to go to 90, 100, 110. Absolutely. Who knows? So I'm not quite sure if crude is really the big risk. Politics to some extent, yes, but it looks like that I think this government in a way has behaved fiscally more responsible than what the situation was, say, in 2013. So to that extent, that's a less of a risk. I think the biggest risk right now is global. Somewhere down the line, I think the global markets are kind of showing some bit of calmness, which I think can probably end up being a bit unnerving at some point of time. Right now, if you really look at the world, the big positive right now is that global growth is good. The US economy is doing very well. But I think the US Fed's commitment to rising interest rates, to raise interest rates gradually over the next few months or few quarters, I think that's probably still the biggest risk out there. I think, therefore, the risks are more global rather than local.
Okay. I want to ask you a question which you will probably dodge, but I still have to ask you. I mean, you're a master of finding out these smaller stocks. Okay, that's Bharat Forge numbers. Just a minute. You want to just say whether they are better than expected?
They're actually absolutely
so
in line. Yeah, absolutely in line with estimates. So no problems at all. I mean, these are good numbers, really. So if you look at it, the revenues at 1,479 odd crores is about a 20% growth that you're seeing. EBITDA absolutely in line. In fact, slightly better than the street estimates for EBITDA. That's a 20% growth. And the profits as well, almost a 30% growth is what you're seeing. What's most important to check for Bharat Forge is what the management commentary is, because that will come in a presentation separately. But these are good numbers because the tonnage growth for them, as we know, the commercial vehicle space, both in domestic as well as in the North America market, has done very well. Tonnage is up by 30%, and that's why these are really good numbers, but in line with expectations.
Either the analysts know the company very well, or the company knows the analysts very well. I've never seen such a carbon copy of, expectations and actuality. So we will analyze this in a bit. But, what I want to ask you was, Nilesh, you've been a master at finding out these symphonies or some of those standout performers. Where are you training your eyes sectorally to find these outperformers in this juncture?
So I think, Lata, the way we are really looking at the entire investment canvas, what I think we're working on a hypothesis that a year from now, the core economy is going to be a lot stronger. We are believers that basically there's going to be a lot more economic buoyancy a year from now. And in that process, the core sectors, according to us, will actually do well. We don't think interest rates are going to keep rising permanently, or we don't think that some of the commodity-related pricing pressures are going to remain. So I think in the process, we think that cement looks to be a good contrarian bet right now. We believe that the housing activity is going to pick up further momentum. Infrastructure construction is going to kind of do a lot more a year later. And it's quite possible that private capex will probably start picking up a year down the line. And we think that probably cement is the best proxy for all of this. Right now, again, the margin pressures are huge with where coal prices are, petcoke prices are, diesel prices are, freight costs, all of that. Volume growth is still in single digits. But what we think a year later, that some of these headwinds will recede, and volume growth could pick up significantly and perhaps enter into double digit. And that is really a sweet spot to be in. And therefore, we think that right now, cement, I think, has a good chance of being a good long-term contra bet.
Which one? You didn't dodge broadly. Okay.
I just had one question before I let you go on companies like Bharat Forge. I mean, some of these players have seen huge strides over the last many years. You think there's still more to go?
I think over a period of time, one is realized that when there are too many moving parts, it's best to kind of, in a way, stay away from them. And I think, some of these companies, they have exposures in India, they have international exposure, they have too many business lines. So at some point of time, there'll be some kind of moving parts which are kind of positive, some which are negative, and overall, they'd end up being kind of neutralized. So I'd probably say that I think stay away where things are just a little too complicated or too diverse internally.
Okay, Nilesh, well, thank you. Actually, just one more small question. I think it was 15 years back that I first saw you in studio. You look the same.
Go to fast fitness.
Okay,
Five Gardens, Vadala. Five Gardens, Vadala.
The markets are the same, right? 15 years back, the markets were the same. Markets are the same today.
Seriously.